Welcome to Finbot Insights. In this explainer, we will conduct a systematic analysis of the popular income-focused exchange-traded fund QQQI to determine if it truly warrants a position in your portfolio for 2025. This is the central question that many income-oriented investors are contemplating. Today, we are going to provide a data-driven framework to help answer whether the NEO's Nasdaq 100 High-Income ETF is, in fact, the optimal choice for the year ahead. We will proceed through a logical five-part structure. We will begin by discussing the broader quest for high yield, then introduce the key technology-focused contenders, conduct a deep dive into QQQI itself, compare it directly against the competition, and finally arrive at our final verdict. Let us begin. First, to properly evaluate a fund like QQQI, it is essential to understand the investment strategy that powers it, the covered call. A covered call ETF is a fund that holds a basket of stocks while simultaneously selling call options against those holdings. In essence, it exchanges a portion of its potential future capital appreciation for immediate income, which it receives in the form of option premiums. This strategy has grown in popularity, particularly following periods of market volatility. This brings us to the fundamental principle of this strategy, which involves a significant trade-off. On one hand, there is high income potential, as the fund collects cash premiums and distributes them to shareholders. On the other hand, the potential for capital appreciation is capped. Should the underlying stocks experience a strong rally, the fund will not participate in gains beyond the strike price of the options it has sold. Now, let us narrow our focus to the specific subset of these funds that are based on the technology-heavy Nasdaq 100 index. This is the arena in which our primary contenders compete. The initial strategies in this space presented investors with a very clear choice. You had funds like QILD, which sell at-the-money call options to maximize immediate income, but this comes at the cost of nearly all potential for capital growth. Then you had funds like JPQ, which utilize out-of-the-money calls to preserve more growth potential, but their structure can lead to tax inefficiencies on the distributions. This brings us to our primary subject, QQQI. It represents a newer evolution of this income strategy, one that aims to address the trade-offs presented by its predecessors. The story of QQI is one of rapid ascent. Launched in early 2024, it has already accumulated over $1.3 billion in assets. It achieves its objective by holding Nasdaq 100 stocks and implementing an actively managed options overlay on the index, all for an expense ratio of 0.68%. However, this is the figure that has captured the market's attention, a trailing 12-month distribution yield in the 14 to 15% range. For any income-focused investor, a yield of this magnitude is compelling. So what are the primary merits of this fund? QQI offers a powerful combination: a high monthly income stream that also allows for a balance of capital growth. A key feature is its tax efficiency, as a significant portion of its distributions may be classified as a return of capital, which can defer taxes. This contributes to its strong total return, which has been approximately 24.10% since its inception. Of course, these advantages are accompanied by significant risks. The fund's returns are directly linked to the high volatility of the Nasdaq 100. As with all covered call funds, its upside is capped, meaning it will underperform the index in a strong bull market. One must also consider the relatively high 0.68% expense ratio and the fund's limited track record, as it has not yet been tested through various market cycles. An analysis in isolation is insufficient. To truly understand QQQI's value proposition, we must place it in direct comparison with its primary alternatives. So, let us examine the critical metrics that differentiate these technology-focused income funds. How does QQQI genuinely compare to its closest peers? This side-by-side comparison makes the trade-offs quite clear. QQQI's yield is comparable to QILD's and significantly higher than JPQ's. Its primary advantage is its tax-efficient structure. The cost for this is its expense ratio, which is the highest of the three and nearly double that of JPQ. The key differentiator, however, is that QQQI is designed to allow for moderate to high growth potential, placing it in a separate category from the pure income focus of QILD. This unique structure has generated considerable positive sentiment among retail investors. It is often referred to as a game changer because it aims to deliver high income without the significant principal erosion that has been a known drawback of some older covered call funds. Having reviewed the data and the competitive landscape, we can now synthesize this information into a conclusive verdict and address our central question. Here we arrive at the crucial point. The term best is not a universal title when it comes to investments. The correct choice depends entirely on an investor's individual financial goals, their tolerance for risk, and the particular tax circumstances. Let us define the profile for whom QQQI is an ideal fit. This investor is likely seeking aggressive monthly income from technology stocks, is comfortable tolerating the high volatility of the Nasdaq 100 for growth potential, and places a high value on tax efficiency. Conversely, an investor who prioritizes stability, seeks broader diversification beyond technology, or is highly sensitive to management fees might prefer an alternative. For those investors, here are several leading alternatives for consideration. QQQ's sibling fund, SPYI, applies a similar strategy to the broader S&P 500, offering less volatility. JEPI also tracks the S&P 500 but with a more defensive positioning and a longer track record. And for a more traditional approach, a fund like VIYM provides low-cost exposure to a portfolio of high dividend-paying stocks. Ultimately, the decision rests on this fundamental question of investment philosophy. For your portfolio, which is the greater priority? Maximizing today's income or maximizing tomorrow's growth? QQI makes a compelling attempt to deliver both, but its primary objective is clearly focused on generating substantial income in the present. We hope this detailed explainer of QQQI and the broader income ETF landscape has provided you with clarity. If you find value in this type of data-driven analysis from Finbot Insights, we would appreciate it if you would click like and subscribe for future content.